There's one book that Warren Buffett, the most successful investor in history, called by far the best book on investing ever written. A book he read at age 19 that he says shaped his entire professional life. That book is The Intelligent Investor, written in 1949 by Buffett's mentor, the legendary Benjamin Graham. Graham's goal was to transform investing from a speculative casino, a game of tips and hunches, into a disciplined, evidence-based profession. His entire philosophy is built on one central question, a question you must ask yourself before you ever buy a single stock. Are you an investor or are you a speculator? An investor, Graham says, is someone who, through thorough analysis, seeks safety of principle and an adequate return. Anything that doesn't meet that strict standard is speculation. And to help us stay on the right side of that line, Graham gave us 3 timeless, powerful concepts. Key idea number 1, your manic business partner, Mr. Market. First, and most famously, Graham asks you to imagine that you are partners in a private business with a man named Mr. Market. Every single day, Mr. Market pounds on your door and offers to either buy your shares in the business or sell you his at a specific price. But here's the catch. Mr. Market is a manic-depressive. He has serious emotional problems. Some days he is euphoric. He sees nothing but a golden future for your business. On these days, he screams ridiculously high prices at you, offering to buy your shares for far more than they're actually worth. Other days, he is inconsolably pessimistic. He is terrified that everything is doomed. On these days, he comes to your door weeping, offering to sell you his shares for pennies on the dollar, just to get out. A speculator gets sucked into this drama. They get excited when Mr. Market is euphoric and terrified when he's depressed. But an intelligent investor understands that Mr. Market's mood is irrelevant. You are not forced to trade with him. You have the ultimate power, the power to say no. You should happily sell to him when his price is ridiculously high and happily buy from him when his price is absurdly low. And the rest of the time, you simply ignore him and focus on the real performance of the business. The lesson is profound. The market is there to serve you, not to instruct you. You are not a victim of its moods. You are the master of your own decisions. Key idea number 2, the ultimate protection, the margin of safety. So if Mr. Market's price is often wrong, how do you know when to buy? This leads us to Graham's single most important concept, the 3 most important words in investing. Margin of safety. Graham explains it like this. The job of the investor is to first calculate what a business is truly worth. This is its intrinsic value. This is a patient, objective calculation based on assets, earnings, and stability. Let's say you analyze a company and calculate its intrinsic value to be $100 per share. An amateur might buy it at $98, thinking they got a small discount. But an intelligent investor waits. You wait for the manic Mr. Market to fall into one of his depressive slumps and offer you that same share for $60 or even $50. That massive gap, the $40 or $50 difference between the value you calculated, $100, and the price you paid, $50, is your margin of safety. This buffer does 2 crucial things. First, it protects you from your own errors. What if your valuation was a bit too optimistic? Your margin of safety gives you room to be wrong. Second, it protects you from bad luck or the chaos of the real world. What if there's a recession or a new competitor? Your margin of safety acts as a shock absorber. For Graham, high returns don't come from buying risky, speculative assets. They come from buying wonderful assets at a price so low that the risk of permanent loss is minimized. Key idea number 3. Know your game, the 2 types of investors. Finally, Graham knew that not everyone has the time or temperament to be a financial detective. So he says an intelligent investor must decide which of 2 paths they will follow. First, there is the defensive investor. Their primary goal is the avoidance of serious mistakes or losses and freedom from effort, annoyance, and the need for frequent decisions. For the defensive investor, Graham recommended a simple, diversified portfolio of stocks and bonds, like a modern-day index fund, which they rebalance periodically. It's a strategy of simplicity and consistency. Second, there is the enterprising investor. This investor's goal is to achieve better than average returns, but this requires a huge commitment of time and energy. The enterprising investor must do the deep, exhaustive research required to find companies selling far below their intrinsic value. Graham's warning is critical. The biggest danger is to think you can get the rewards of an enterprising investor with the effort of a defensive one. You must know which game you are playing. Conclusion: your worst enemy is yourself. So the wisdom of the intelligent investor can be boiled down to 3 core principles. The mindset. You must think of the market as your emotional servant, Mr. Market, not your master. The math. You must always insist on a margin of safety, the gap between price and value. And the method. You must honestly decide if you are a passive, defensive investor or an active, enterprising investor. In the end, Graham's most profound lesson is that the key to financial success is not in the stars or the stock charts, but in ourselves. He famously wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself." By providing a framework of discipline, logic, and patience, Graham gives us the tools we need to protect ourselves from that enemy and to truly succeed in the long run. Subscribe for more deep dives into the best investing books ever written at Rich's Recap. Let us know in the comments, what is the single most important lesson you've learned from Benjamin Graham's philosophy?